Hello guys, welcome to this video. Today we are going to be discussing the difference between finance and accounting. A detailed analysis will be discussed in this video. So stay tuned till the end. And if you are new to the channel, please make sure you like, subscribe and tap the bell icon for more content about accounting and finance. So let's get started. First of all, we'll discuss about the definition of accounting and finance. Like we discussed in our earlier videos, accounting is a systematic process of recording, classifying, summarizing, reporting the financial transactions. If you have not gone through the previous video in which we have discussed about the definition of accounting, a detailed explanation about what is accounting has been given in the very first video of this channel. So do check it out. You will get a clear picture of what accounting actually is. Right? Then we'll discuss about what is the definition of finance. Finance is managing money, investment and financial planning for decision making. Managing the money. So the database which is generated through accounting gives us a detailed overview of where we have spent the money and from where we have received the money. What are our assets? What are our liabilities? What are the upcoming payments? What are the future revenues which are going to be generated in the business in the coming period of time. So how this is generated? Through accounting we are getting different statements like balance sheet we are getting, trial balance we are getting income like profit and loss statement, cash flows we are getting. So these statements which are generated through accounting are helping the business to make financial decision. How the money expenditure is to be done in the coming week, coming month or coming year. These decisions can only be made by looking into the financial position of the business, which is done through accounting of the financial transactions. So this is the main difference between accounting and finance. Accounting comes before finance. Finance comes after accounting. Finance is more related to decision making based on the data which is generated through accounting in the form of financial statements. Right? The objective of accounting is to accurately report past financial transactions. So accounting is basically a database which is generated based on a historical data which is recorded by following a compliance, by following a principle, by following a rule, right? Based on those rules, a database of a business is generated, and that is what accounting is all about, right? And what is the objective of finance? The objective of finance is to manage current and future financial resources effectively. So based on the database that is generated by accounting, a plan is set as to where the business is going to spend the financial resource, which asset to buy, and where are we going to spend money on, which creditor is to be paid in the coming time. Through cash flow statements, what is the amount of money which we are going to receive, what is the amount of money which we are going to pay to which creditor, to which debtor are we going to receive the money. All this data is generated only through accounting the financial transactions, right? And finance is about managing the money through the database which is generated by accounting. So these are the objectives of accounting and finance. Then we'll talk about the core activities. The core activities of accounting are journal entries. Journal entries are more about the debit and credit entries which we are recording about the financial transactions of a business, right? And accounting is also about financial statements like preparation of trial balance, balance sheet, profit and loss statement. And accounting is also about compliance and audits. Compliance is all about following the concepts of accounting which we have discussed earlier in our earlier videos. If you are not gone through the accounting concepts, you can go to my second video and check out. I have given a brief explanation about the accounting concepts which will be easier for you to understand once you watch the entire video. And yes, audits are also necessary to find out whether the business, whether the financial transactions are recorded as per the principles or not. For that reason, audits are being conducted. Then what are the core activities of finance? The core activities of finance include forecasting, capital budgeting, and risk management. Forecasting, from where the money is going to come in the future coming period of time. In the next week, what are the amounts what is the inflow which is going to come from the debtors, what are the amount which we are supposed to pay the vendors, what is our bills payable over the coming period of time. So this is forecasting. It's about preparing the cash flows of the business. Forecasting is about preparing the cash flow. You must have heard about cash flow statement in your college time. So it's about preparation of the cash flow statement, cash flow and fund flow, right? Then capital budgeting. Capital budgeting is about investing in different projects. Through different tools and techniques, you will find out the profitability of a specific project. Under capital budgeting also, there are various techniques to know the feasibility of the project, whether it is profitable enough to invest in a project. So that is what finance is about. It's about capital budgeting. And risk management. Investing in a specific asset, will it be profitable or not? What is the scope of loss in investing in an asset or a specific stock? Risk management is about these factors. All right. Then let's talk about the perspective of accounting. Accounting perspective is historical focus and objective data. So historical accounting is completely dependent on the historical data, the transactions which have taken place previously. It is more about those transactions, not what is going to happen in the future. What is going to be happening in the future is about finance. Accounting is more pertaining to the historical data which has already taken place in the business. And the second perspective of accounting is the objective data. Based on the data itself, we are deriving the decisions, the business decisions in the coming period of time. Then talking about the perspective of accounting, finance is more future oriented and analytical and assumption based, right? Future oriented, it means we are taking a decision for the future of the business. Where are we going to spend the money on, right? And when are we going to receive this money? It's just an anticipation. So that is why it is future oriented. Whatever we have planned, whatever we have forecasted, it need not be as we planned it out. There could be some changes. There could be, most of the times there are things that not go as per the plan. There could be a few things which you didn't even expect, contingencies. So these things are also part of business, and finance is more future oriented. And finance is also analytical and assumption based. In finance, there is nothing that is specific. If we say that this event is going to happen, this amount we are going to receive from this debtor on this date, when we determine that, it is not necessary that it will happen as planned. That is another perspective of finance. Then we will talk about the tools and techniques of accounting. Accounting is more about bookkeeping, GAAP/IFRS. That is, GAAP means generally agreed accounting principles, and IFRS is about International Financial Reporting Standards. Accounting has softwares like Tally, SAP. These are only two accounting softwares which have been mentioned, but there are a lot of other softwares which are used in the business for accounting the financial transactions. There is ERP, there is Oracle, there is QuickBooks. QuickBooks is mostly for small businesses. Even Tally is mostly for small businesses. Most of the companies are using SAP as their financial recording software, right? So let's discuss about bookkeeping. Bookkeeping is maintained for recording the regular day-to-day financial transactions. Based on bookkeeping itself, the accounting is done in the small businesses. And GAAP, like I said, it is generally agreed accounting principle, and IFRS is international financial reporting standards. GAAP and IFRS standards have to be maintained while recording the financial transactions, and these are some techniques of accounting. And Tally and SAP, as I said, these are the financial tools which are helpful in recording the financial transactions. And for finance, there are DCF models, there is CAPM, and portfolio analysis. Now your question will be, what is DCF model? DCF model is a discounted cash flow model. It's a valuation method that estimates the present value of a company or an investment by discounting its expected future cash flows. It's a way to determine how much an investment is worth today, okay, based on the money it's expected to generate in the future. Based on the money which a business is supposed to make, based on that data, based on that historical data, the future amount of money which the business is going to receive is calculated, and that is called as discounted cash flow method. It's a valuation method to basically derive the cash flows of a business. Then talking about CAPM, CAPM stands for Capital Asset Pricing Model. It is a financial model used to determine the expected rate of an investment based on its risk. It helps assess the risk adjusted return of an investment by quantifying risk and translating it into expected equity returns. The model provides a framework for estimating the cost of equity, which is the return investors require for holding a company stock. So it's basically a model that is used to determine the expected return of an investment based on its risk. And talking about portfolio analysis, now what is a portfolio? Portfolio is basically the sources of investments in which a business or an individual has invested his money. Now my portfolio may consist of various stocks, it might consist of various futures and options, it might consist of cryptocurrencies. I have a portfolio of investment. I have invested in Bajaj Finserv, I have invested in Tata Steel, I have invested in Adani. So this is my portfolio, and how much money I have invested, that is my portfolio. So finance is more about analyzing the portfolio. What could be the investment return which could be generated through this investment? That is what finance talks about. All right. Then talking about the career roles in accounting, we have accountants, auditors, tax advisors. These are very generative roles in accounting. Accountants, auditors, and tax advisors are almost part of every business where there is a financial transaction. And the roles in finance are about financial analyst, investment banker, and CFO. Financial analyst is at the executive level, but investment bankers are more about managing the customers' funds and recommending them to invest in which specific stock, which stock could give a higher return. Investment banking is about that. CFO basically acts as a main focal point, who is into more of decision making, and he takes the decisions for the business or an entity. So let's discuss about what is the relation between the two, that is accounting and finance. Accounting provides the data foundation. So it provides a base, a foundation of the business transactions. Finance uses that base, that data, which is generated by accounting for strategic decisions. Based on the strategic decisions that are made, there are tactics to make those strategic decisions work. Those tactics are operative. Those tactics are followed on daily basis to make sure the strategic decisions are well intact and well on track. So this is the relationship between finance and accounting. Let's take an example to illustrate. Company sells products worth rupees 10 lakhs. For accounting transactions calculates profits. So based on the sale of 10 lakh rupees, what is the profit that has been generated through the sale? The accounting is calculating that. And what finance does is it decides reinvestment, dividends, or acquisitions. So based on this accounting, what finance does is it decides whether to reinvest in that specific asset or not. Whether now we have got a profit of 10 lakhs, investing in the same asset will regenerate the same amount of profits or not is decided by the finance. And dividends, what is the share of profit or dividends the stakeholders are supposed to receive, is what the finance also decides. And the finance also decides about acquisition, acquiring an asset, acquiring a business altogether. So these decisions are done by the finance. So here is a small summary table. Accounting is more descriptive, historical, and narrow in scope. These are the features of accounting. And finance is more analytical, forward looking, and broad in scope. Accounting, you can say, is a narrow concept. Narrow in the sense it provides a strong foundation of a data based on which finance is able to make decisions. And it is broader in scope. Broader in the sense there can be various types of decisions that can be taken with the help of data that is generated by accounting. So guys, that's it for this video. I hope you found this video helpful and informative. If you are new to the channel, I once again request you to please subscribe to my channel and share this video to your friends as much as possible, to your classmates. And I'll see you back in the next video with some new accounting topic.